So when you take a look at the breadth of pretty positive earnings results that we've gotten so far, how much of this has actually been priced into asset valuations?
Right. I think it's not fully priced in yet. I think there could be an argument that a lot of the positives are already priced into the markets. If you look at the levels where PE is trading at, and even in some part of the credit markets, the fact that credit levels are very tight. But I would make the case that there are many signals that tell us that there could be more for this market to go, this bull market to go. Now, for one, the spread between earnings yield and where real yields are is still at a historically high level. And second, the differential between the PE levels of growth and value stocks are still at very wide levels at this phase of the economic cycle where we are at the base of a hockey stick in terms of growth. So I do think that not all the positives are priced in. We think that for the S&P, we could see something as high as 30% year-on-year growth in terms of EPS this year. And there is more impetus for the bull market to continue over the next 12 months ahead.
So one of the risks that you say you're hearing from clients is still this almost evergreen now concern about the inflation situation deteriorating significantly. Is that something that you're taking into account in terms of your investment decisions and positioning?
Absolutely. And, in some ways, this is the million-dollar question for markets. And I think the Fed addressed it in the FOMC meeting as well. Now, we do expect inflationary pressures to escalate over the next few months. A lot of this will be due to base effects. But the underlying momentum will be transitory, and this is an inflation scare, not a crisis. Now, the structural forces that is pushing inflation down, such as technological innovation and demographic change, remains very much in the background. And we do think that ultimately the turbulence that we've seen in terms of the inflationary scare, the rise in bond yields over the last 2 months will be self-limiting. And the picture will very much shift to the the underlying fundamentals such as earnings, which will drive equities further over the next 12 months.
Well, you also in your notes say that you're overweight U.S. and Asia and cyclical sectors. So could you be a little more specific on that part of it?
Right. So, well, for one, we do think that, again, the earnings outlook for U.S. equities remains very strong. In China, there is some fear that policy normalization could be premature. But however, we are comforted by the fact that the authorities in China are taking a very calibrated approach in terms of normalization. And in fact, the credit impulse that we saw during the pandemic was smaller than what we saw during the GFC. So the backlash should be smaller as well. And in terms of sectors, we think that the cyclical sectors tend to have a higher beta to economic growth. So that includes the financials, the industrials sector, energy, commodities, real estate. And let's not forget, now the infrastructure bill in the US is expected to be ratified later this year. And this will have a direct impact in driving the earnings of these sectors as well.
So in terms of the biggest risks to your outlook, because it seems the biggest upside risk may be that the vaccine rollout, say in the U.S., goes even faster, starts picking up steam, India gets its situation under control, boom, and things are even better. Do you agree with that? And what's the biggest downside risk?
Right. So I think the two biggest downside risks would be, in addition to the vaccine picture, one, that we see the credit normalization in China being premature. And second, that inflation could go out of hand, right? Now, I think the vaccine rollout, there's going to be some ebb and flow over the near term. We are not going to go in a straight line towards reopening. But if you zoom out to the larger picture, now, despite some really negative news over the last few months in India and some other emerging markets, now, if you zoom out, global rates of vaccination are increasing slowly. And global rates of hospitalization are falling as well. And, the economic data is bearing this out. I mean, PMI numbers, employment numbers, consumption numbers, these are on the uptrend.
They sure are. And again, in the bond market, we've been kind of mentioning the Fed, but we think of that more in terms of sovereign bonds and treasuries, et cetera. When you look at the corporate bond market, when you look at high yield, What are you buying? What do you want to stay away from?
Right. Now, we still like emerging markets. That means Asia, LATAM, some parts of EMEA as well. There is, of course, some concern that the fact that China is a very large part of the emerging market universe of credit there. And of course, we know that the Chinese authorities are trying their best to encourage more healthy price discovery and discourage moral hazard there. So I think more important than ever, while the spreads are still at fairly attractive levels in our view, we think that it is very important to diversify into some of the emerging markets outside of China, and to, again, I think, look for exposure to the cyclical sectors that we think will be beneficiaries of the economic uptrend in this early part of the new post-pandemic cycle.